Federal Reserve is incompetent. They are looking at data in the rearview mirror to dictate their policy decisions today. They are going to hike us into a recession. We're going to see mortgage rates move to 5% next year. Inflation's already rolling over, and there is an opportunity in housing that nobody is seeing. Stay to the end of the show to really understand what's happening in the economy, why the Fed is doing too much too fast, and why there's a big opportunity in housing today. Hey everyone, welcome to the Dan Habib Show. I'm Dan Habib. A couple quick reminders before we get into the content here. If you want the best insights in the mortgage and real estate space every single day, check us out at mbshighway.com. You can sign up for a 2-week trial. And if you are interested in learning more or investing in crypto and you want an edge, check us out at CryptoCharged.com. If you use code Habib, you will get 40% off today. Now, please, one more reminder, please like and subscribe below. It will greatly help the channel. So team, there is a lot going on in the economy right now. And you certainly can't look to the media to get a clear picture of what's happening. But we, make no mistake about it, are headed for a recession. And the Federal Reserve, this group of mad scientists there dictating some of the most important policy in the world, are looking at lagging data to make their decisions. The Federal Reserve has one main tool that they're using to try to curb the biggest problem that we're seeing in today's economy, which is inflation. But I'm going to tell you why inflation has already peaked and is starting to head lower. But let's go back to the Fed. So the tool they have is called the federal funds rate. A lot of misinformation out there about this. You'll see the media say the Fed is hiking mortgage rates. Couldn't be further from the truth. The Fed is hiking an ultra short-term rate called the federal funds rate. And this is actually an overnight rate that banks use to lend to one another. When the Fed hikes, it has a direct impact on certain things. Short-term treasuries, short-term yields. We're talking about things like credit cards, car loans, small business loans, which is a big one. Imagine a small business that could have borrowed, let's say, at 2% when the Fed funds rate was at 0. And now that the Fed funds rate, they've hiked it to 4%. Now they have to borrow at, let's say, 6%. That's going to deter a lot of businesses out there from borrowing money, doing expansions, and will slow down the economy. Now, listen, the Fed is being successful in this. The Fed has certainly slowed things down. We've started to see inflation come down, but the Fed is looking at lagging data. The Fed looks at things like the unemployment rate, which is still pretty low at 3.7%. And the Fed says, we're not headed for a recession. Inflation's still too high. We need to keep going full steam ahead. But here's what the Fed doesn't realize. Number one, the Fed funds rate, when they hike this, it has a lag effect. Immediately, the markets, the stock and bond market, will try to price in what a Fed rate hike means. But for it to actually filter through the economy, it could take longer than 6 months to feel those impacts. And the Fed has already hiked from 0 to 4% since March of this year. That is one of the fastest paces that we've ever seen. And the Fed is not waiting for this lag to catch up. They're not waiting to see the cumulative impact of their rate hikes and what it's going to mean for the economy. But here's the thing. When they look at things like the unemployment rate, that is the most lagging indicator out there, and it is always the last shoe to fall. The unemployment rate, it is literally at 3.7%, but it's been around that range many times before we saw a recession. The unemployment rate does not top out or get very high before a recession. It's actually quite the opposite. The unemployment rate reaches its lowest point, which it did, in my opinion, a few months ago with 3.5%, and then begins to turn higher. And then those newly unemployed people, they stop spending. Those businesses that were relying on it, they start to hurt. They have to reduce headcount and lay people off. And then you see it jump up as you get into the recession. But just because we have a low unemployment rate does not mean we are not 100%, in my opinion, headed for a recession. But there's other indicators out there. We've seen an inverted yield curve. That means that normally a yield curve is up and to the right. If you put your money away for 10 years in a 10-year treasury versus 2 years in a 2-year treasury, you would expect to get a higher rate of return for putting your money away for 10 years because you're committing your money for a longer period of time. Well, that's not what we're seeing right now. We're seeing what's called an inverted yield curve. The 2-year treasury yield is much higher than the 10-year treasury yield. That's inverted. It's backwards, upside down. You can even look at the longest maturity treasury, the 30-year bond. And if you compare that to the 1-month treasury, even that went inverted. That means that you get a higher annualized rate of return for putting your money away for 1 month versus 30 years. That is a sign and symptom of weakness and scarce people being scared in the economy. This is something that with almost 100% accuracy forecasts a recession to come. But that's not all we're seeing. Consumer sentiment, extremely weak. Now, some people might point to the fact that retail sales were still okay, meaning how much people are spending on retail within the economy, but they're not looking past the headlines. Credit card debt up 15% from last year, the largest increase that we've seen. You look at the personal savings rate, down to 3%, the lowest since the 2008-2009 recession. People got addicted to this drug of stimulus that we've seen in the economy, and they haven't changed their spending habits, but what they're doing now is they're putting everything on credit. That has a limit, that has a maximum that they can utilize, and we're already beginning to see that roll over. This is going to cause an upcoming slowdown in the economy. But we're also seeing layoffs happen. The tech sector, a bunch of them just announced huge layoffs, 10% of the company, Amazon laying off tons of workers, Facebook or Meta. This is starting to show up in the numbers of initial jobless claims, people filing for unemployment benefits for the first time. But if you look at continuing claims, those that continue to receive benefits, that's up over 205,000 over the last 7 weeks. That means that when people are getting laid off, they're not able to find another job again, and they're continuing to receive those unemployment benefits. And how about the housing market? If you see activity in the housing market, boy, that is down sharply, and that's a big contributor to GDP. And GDP, we know Q1 and Q2 of this year were both negative consecutively. Everything is pointing to a recession, and everybody out there that has any kind of weight and knows anything about the economy sees this coming. Why do you think these big tech companies are starting to lay people off? They're seeing the future before it becomes obvious, and they are making changes to their companies to prepare for this slowdown. The only ones out there that can't see it is potentially the administration as well as the Federal Reserve. Now, why is the Fed doing this? Why is the Fed hiking the Fed funds rate at one of the fastest paces we've ever seen? It's because of inflation. And they've been successful, but they just don't know it because we've started to already see inflation come down. At the peak, it was at 9.1%. The last reading on November 10th, it's at 7.7%. But look at some of the other components that are within this. You can see used car prices down 14% from the high. Fertilizer prices, which is a strong correlation to food, down 39% from the peak, and container prices are down 73% from the peak. How about oil prices? That's always a big one. It filters its way into everything as far as cost goes. That's moving lower, and I think it will continue to do so, even though OPEC cut production, and a big reason for that is because of these COVID-zero policies in China, and they just announced that they're extending their lockdowns. The one part of inflation that hasn't rolled over yet, that is the lagging component, is shelter costs. Shelter costs make up more than a third of the inflation readings that we're getting. And if you look at the core rate, which ships out food and energy, it's 39%. But this is looking at old data. This is showing shelter costs continue to go up when we know in the real environment, shelter costs on a year-over-year basis have started to come down. I believe that will catch up in the beginning of 2023 and even add further decline or downward pressure to inflation. But not only that, if you take a look at the year-over-year comparisons, if you look at the months now and what months we're going to be replacing from last month, because remember, this is a rolling 12-month report. That means that as we get the November reading in December, it replaces the November reading from 2021. The comparisons from last year, they get much, much tougher. So it's much easier to see that year-over-year inflation reading come down as we go into the future. Bottom line, my expectation is that we're going to see inflation move significantly lower in the first half of the year. And because inflation is the main driver of mortgage rates, I believe that means we're going to see mortgage rates come down to 5% in the first half of next year. That's right, 5% in the first half of next year. And I think that is going to create a lot more activity in the mortgage and real estate space. But let's talk a little bit about housing, because right now I believe there is an opportunity in the housing market that nobody's talking about and nobody's seeing. Yes, it's true. Mortgage rates are high. They did get up a little over 7%. They have come down since, guess what? The last inflation reading that we received on November 10th. We actually saw one of the biggest one-day drops in mortgage rates after that inflation reading, where rates dropped by about 0.5%. They dropped 0.5% since the Fed hiked 75 basis points on November 2nd. For those people out there saying mortgage rates are higher because of the Fed, it's just untrue. Mortgage rates are higher because of inflation. Inflation erodes the value of a long-duration bond's fixed return. But as the Fed hikes and as they curb inflation, that means that we're going to see mortgage rates continue to come down. Now, when we take a look at housing, Yes, it's true that housing activity is in a recession. We're seeing very little sales out there, but at the same time, there is extremely tight inventory. And the reason for that is builders have learned their lesson. Let's get into this. So if we look back at the housing crash, which the media leads you to believe that we are in, there was 4 million homes for sale around 2006, 2007. And back then, you saw activity waning. Activity was declining much like it is today, but builders still put homes up in record numbers. They completed the most homes that they ever had, while at the same time, you had activity or demand waning, and you also had these risky loans being done that should not have been. No wonder why we had a housing bubble. Fast forward to today. You have 1.22 million homes for sale. So, about a quarter of the homes for sale than you saw during the housing bubble, but builders learned their lesson. Housing starts, which is builders starting to do construction on a new home, it's down 22% from last year for single-family homes. How about single-family permits? Down 21% from last year. Builders don't want to be put in the same position. But with rates coming down to 5% next year, I think there's an opportunity to be had here. Listen, you don't have to marry the rate, as people like to say. Okay, you can date the rate. And what that means is there's strategies out there right now where you can buy a home, and because there's no demand, you're not going to have all this competition. Remember, a year ago, 2 years ago, there was 30, 40 offers on a home. You had to pay $50,000 over asking price. Yes, rates were lower, but you had to buy this home in many cases sight unseen. You couldn't even see the house. You couldn't get an appraisal. You couldn't get an inspection. You didn't even know what the heck you were buying. Well, now today you have the opportunity for not only all those things, but you can get some seller concessions or seller contributions, meaning you can get a price reduction. You can get the seller to pay for things like a 2-1 buy down, which makes the 6 3/4 or 6.5% rate today lower for the first by 2 percentage points for the first year, and then lower by 1 percentage point for the next year. But you don't anticipate to be in the home for that long, because remember, if rates drop to 5% next year, you are going to have the opportunity to refinance that mortgage. But you will now have the opportunity to get in when there's not a lot of competition, when you have the ability to negotiate. And then think about this. Next year, when all those buyers that are dormant right now, that are in hibernation because they don't want to move from their 3% mortgage rate to a 6 3/4 mortgage rate today, they're going to come back. Those people that wanted to move, they're going to come back. Those people that are thinking about buying a home, they're going to come back. But when they come back to this very tight inventory environment, and an environment where builders are not building homes, what's going to happen to activity and what is going to happen to appreciation? It's going to reaccelerate. You will have missed the opportunity. So think about that. The other thing I want to just address is the media talks about appreciation in home prices, and they have no idea what they're talking about. One of the best appreciation reports out there is called Case-Shiller. They look at actual resale volumes of homes so they can see what a home sold for versus what it sold for at a different time. Now, this report at the peak showed that there was 20% appreciation on a year-over-year basis. Now, it's come down recently to 13%. The media is all over this. This is the biggest decline in home prices that we've ever seen. It went from 20% to 13%. First of all, that does not mean a decline in home prices. What that means is the year-over-year acceleration in appreciation went from 20% down to 13%. It's still up 13% from last year. But last year, we were seeing 2% gains in home prices each month. So it's no wonder why we're seeing a slower acceleration or pace of appreciation. Now, how about real home values? Well, if you look at the Case-Shiller Home Price Index, over the last 2 months, since the peak, we have seen home values decline in total by 1.5%. In some markets, you're not even seeing any decline, some a little bit worse. This is the national average, but a lot of this is really focused and it's concentrated in some of the bigger cities that saw some really big appreciation gains where things got a little overheated. But 1.5%, boy, that's not too big of a deal. And going back to the acceleration in appreciation, if you go back to 2018, we actually saw back then home price values on a year-over-year basis of the increase go from 6.5% to 3%. If you look today, it went from 20 to 13. The decline back then on a percentage basis is actually 55% versus 35% today. If that scared you in 2018, what kind of an opportunity would you have missed in the housing market? The media has been negative on housing for the last 10 years. Home values since, what have they done? Well, from 10 years ago to today, they are up 115%. Just over the last 2 years, they're up 39%. I anticipate to see a little bit more softness and a little bit more decline in activity coming up in the next 2 months or so. But I think then you will see a real reacceleration in home prices as rates come down next year. And I think this actually, counterintuitively, can be a big opportunity. Remember, it's like some of the most famous investors out there have said. You got Warren Buffett, buy when others are fearful, right? You want to be a seller when others are greedy. Or how about Baron Rothschild? You want to buy when there's blood in the streets. Think about this, team. But the other thing I want to just talk about is the Federal Reserve one more time here. The Federal Reserve, the reason why they are incompetent is because they are not seeing the fact that the economy is heading into a recession and they should be slowing down or stopping the rate, their rate increases and giving the economy a chance to fully absorb and reflect the cumulative impact of those rate hikes. Instead, they plan on hiking another 50 basis points in December on the December 14th Fed meeting, and then we'll see what happens from there. But I think the Fed may be forced to start slowing things down, as in the coming months we see inflation move lower and we see the job picture get a lot uglier. I do not think that a 4% unemployment rate is too far in the distant future. But one thing you want to keep in mind, team, is that with the U.S., in my opinion, definitely headed for a recession within the first quarter, you can likely see some more declines in asset prices. So if you think the bottom's in and you want to start buying with two hands in the stock market, in the crypto market, I would think again, and I would think twice. I think these are good areas to potentially start thinking about dabbling, doing some dollar cost averaging. But you want to keep a lot of dry powder on the sidelines because I believe the lows are not in. Those June lows in the stock market, I think they're going to be taken out. I think you could see another 20% decline in stock prices from here. The crypto market, I think you could see Bitcoin come down to the, let's call it 11 to 14,000 range. But at all of these ranges, I am a big buyer at this point. So at those points. So team, until next time, have a good one.